Hey guys, welcome. You're with, you guessed it, the Market Sniper. That's right. And I'm going to give you an update on a couple of key things that have happened in a while. So coming at you from the southern part of the hemisphere, we're going to discuss in this video, right at the end, you will get a gift trade that has potential. Listen to this carefully. That has potential for risk reward ratio of 1:1400 plus. Anyone interested in a 1:1400 trade? What do you think the odds of actually landing a 1:1400 trade? That means, by the way, if you put $1,000 on risk, you would in fact get 1,400 times 1,000, which, if you know your mathematics, it would be 1.4 million. Anyone interested making 1.4 million on 1,000? Hit the like button right now. Hit the like button right now if you want to hear about what that potential trade is. By the way, as you may well understand, these things have been pinched on risk so tight that you may have to enter a number of times. Therefore, if all you have is 1,000 to risk, you won't be able to take this trade at all. If you have 100,000 in your account, you can risk 1%. You can probably risk it 4 or 5 times before you might have to call it quits. So remember, to get this one particular trade right, you're A, going to need patience. B, you might have to have multiple goes. I will be telling you what the 1:1400 plus trade at the end of this video. I am also going to cover the recession story regarding the Fed and new definitions for a recession. I am also going to be covering the Euro Swiss franc, other FX moves that have been occurring and are out there, and the malaise of the Euro experiment, the political experiment that is Euro land, and the beautiful world of energies surrounding the beautiful experiment that is Euro land. Indeed, indeed, indeed. We will be talking and looking at a couple of those. In fact, we can refer to my Twitter feed. Let's start with the redefinition of recession. So it's quite a specific, hardwired fact that a recession has been defined as 2 consecutive quarters. That means 3 months, aka January, February, March, negative GDP growth, followed by another 3 months, for example, April, May, June, where once again you are negative GDP growth. That is back to back. That means an entire half year. The data that has come in for the previous 3 months has indicated that the economy is contracting. Yes, it's quite simply stated. However, we learn from the whitehouse.gov, and trust me, these are under the auspices of yours truly, the cabal of central bankers for releasing it. It may as well have said the Fed, but they're going to politicize this to deflect some of the blowback on the Fed, but this is Fed. And this note the English that is used here. This is the deception. These are deception times. These are the people that are mealy-mouthed deceivers. So having defined an economical fact that I've known for decades, that 2 contracting quarters is in fact a recession, we're now saying, while some maintain, some, it's almost as if there's a lunatic fringe out there that sometimes says real stupid things, aka repeats the definition for a recession. The way economists evaluate, this is neither the official definition nor the way economists evaluate. So suddenly now all economists are deemed to have abandoned the nature of a definition that has always stated 2 consecutive contractions. I wonder what, let's say, the lefty Democrats would be saying if it was a Republican Party in charge and they were now saying real economists never refer to 2. This is a complete lie. Any sane economist does, in fact, mention the key definition. However, both official determinations of recessions and economic assessment of economic activity are based on a more holistic look at the data, including the labor market, consumer and business spending, and industrial production and incomes. Based on these data, it is unlikely that the decline in GDP in the first quarter of this year, we already got 1 negative for January, February, March, we should be hearing, I expect today, even if it was followed by another GDP decline, which I'm expecting it probably will be for the likes of April, May, June, is followed by another, indicates a recession. No, it's the definition of a recession. But no, they say no. Because, why? Because we've got the super hot labor market for pizza delivery boys. You know, there's so many jobs unfilled. Domino's has at least 3 or 4 positions available for some zero contract hour jobs, etc., etc., etc. Where, Fed, as I've done many Fed trolling chats, Powell has always said the red hot labor market. What garbage for what crappy jobs they have red hot labor market, I can only imagine. But you can guess that it's not the high paying variety in these current recessional times. It's not worth taking. You may as well stay at home and try second sell garbage for Amazon and pick up a commission rather than doing much of that menial low cost income. So that is how they are weaseling, and this is called weaseling. You just learned that what once was a definition that served multiple decades is no longer a definition. In fact, serious economists, in fact all economists, evaluate the state of the business cycle differently. That's a fascinating restatement of definition and history. So that's where we are on that. Let's have a look. Let's have a wee peek at things surrounding Europe and energy. So Europe, energy markets. This is getting really sexy. And this is going to lead on to our update on the Euro Swiss franc. In fact, let me refresh it over here. I've retweeted many of them and they should be in our mix. So let's have a look if we can get that over there. Hootsuite's a bit slow. So Wall Street Silver, I'm reminding us, had a chat with those guys, appeared on their show, good guys. This is the gas market, natural gas in Europe, back over $60. This is reapproaching, guys, previous spike highs. This is properly moving. This is not looking great at all, but we're supposed to be hurting Russia. Wow. If you were deciding where to build a business, would you do it in Europe with their current energy policies around that? Never mind the carbon taxes and everything else that is going on. It's absolutely unbelievable what's going on the energy markets. This horror chart suggests that Germany is heading for a huge energy crisis. This is Holger, he's a good follow, by the way. Not only has gas price risen near record highs, but electricity prices in particular, 1 year ahead power prices in Germany. Guys, this is the manufacturing workshop, probably the only consistent net exporter in Europe that is holding up the entire Ponzi schemes. So you've got your gas prices at near highs, which I was showing you, and this is your electricity prices absolutely mooning on a 1 year ahead price. This is going to be shut down Europe. It is absolutely shut down Europe, guys. I'm sitting in a place where they have load shedding occasionally, and everybody will think, yeah, third world, South Africa. Watch out, Europe, lest ye be too full of pride. I can see it coming. I can see it coming for all of them. You will be flattened. So here's Agent Orange doing her mongoose surprise impression as the Bund spreads start to stretch. Let's have a look at what else is happening in energy. So America are selling off their strategic petroleum reserve. So they'd already committed to a previous plan to sell 180 million barrels. So now they're going to add a further 20 million barrels to this in a bid to try contain, my friends, the great oil price, which has been stubbornly strong. We'll be coming back to that Euro Swiss franc chart in a minute as well. Don't you worry. Stubbornly strong. So let's take you to oils and have a look at those for you so you can see. So what's consistently happening is you've got WTI at around $95, $96 and Brent at about 105. So between the two, you're still averaging around 100, and that's after a fairly significant pullback, after a bit of a blow off. Note the candlestick shooting stars, always a warning. Shooting star failed to make a new high and a sell-off. So that is probably the end of the first major macro leg move up. You had a little bit of a tip-tap-toe moment there for a bit, but I can tell you it's going to be disappointing if you're thinking it's going to come too far down. Short of them engineering, which is what I assess they will do, one of the biggest and greatest, not only recessions, but demand-killing, almost depression, which may require a bank hack that zeroizes all bank accounts. How about that? Oh dear, so sorry, so sad. Those commercial banks will kill him. You can deal direct with us from now on. All those jobs will go. And of course, now you can have a central bank digital currency, which you can use only subject to our rules in a manner that is tied to your social score and all of those other things. But first, a bit of problem reaction solutions, supply shortages. Everybody got no money, got no demand, and more means to exchange. We can just do a full-on, even bigger than the COVID event demand killing. Yep, that could bring oil price down substantially. But you're going to need that level of downside to even remotely focus on it. By the way, those natural gas charts, let's just have a look at them. Everyone was saying, that's it, it's contained. And it was down, down, down. And now we have a look and you're snapping back up. A little bit of exhaustion now when it's getting to these levels. But this is normal NYMEX. This is not the European. The Europeans have special pricing. Special pricing because gas doesn't travel well and it doesn't travel easy. So what applies for America doesn't nearly as easily apply for good old, and there's our Germans chuckling when Trump inaccurate claim about you'll become totally dependent on Russian energy, otherwise you're going to have a laugh, a difficult old time. And they were cackling their hearts away. Look at them. So smug and so smarmy, laughing at the big fool who is actually predicting their future and has done so pretty well. That is not a pro-Trump tweet, though, but it was indeed something that was very, very reflective of that. So the strategic oil is being released. Let's have a look at that. Alisa is worth a follow, by the way. Check him out. It looks a solidly decent guy. He's not ever doing shilling anything really hypey, and always puts out an interesting tweet. He's got out here the German power baseload calendar month futures. Contract for December hits an all-time high. Look at that chart, guys. Look at that chart. Look at what he's showing you. These German power baseload calendar. This is what they're going to have to buy in. I mean, essentially 2021, you're at a level of 50, and now you're at 524. Can you imagine what that forward purchasing of energy at the current prices is truly going to do to the inflation in Eurozone land? How can you not see the failure of the euro? As strong as we've leaned on the yen, we have continued to say you have to short the euro. And that is another reason why the Dixie still will go up, even when the dollar's kind of indifferent. It's not strong. It's not the laggard of the pack, but it's not having a particularly viable day. You'll have the Japanese yen pulling back a little bit after the yields turned around. And so the Dixies, the dollar's not dominating the yen. And what do you have? You have the euro's turn to properly puke. And you're going to keep having this. First, it was the yen, absolute spiller, thriller, all the way from Manila. If, of course, you're trading it on the USDJPY, it's a mooner, and up she goes. And now we're having euro land. And how many times have we warned you? Let's go with all of these energies. I think you're getting the message here. Let's go to that euro Swiss franc. And I want to remind you, when you are battling with direction, really simple thing to do is focus on the macro charts. Focus on the macro charts. Now, we've shown you the setup, and we have called previous crashes on the euro Swiss franc multiple occasions. The two big sell-offs from up top here at 150, there already was SNB intervention at a macro level. That ended up with a low sub 1 with overperformance. That's right, my friends. I'm not going to put the jaws up yet until I just first illustrated on the overlay here. Squeezy, that Japanesey. I got taken in 2009, and I ended up calling the Greek crisis before anyone had heard the phrase the Greek crisis that later became the pigs crisis, on a euro Swiss franc trade, a landlocked nation that is relatively gold fiat equivalence against a absolutely politicized experiment that should be allowed to fail for everything it was. You can't have monetary standardization and not have fiscal policy standardization. And of course, it was designed to fail. And of course, you've had this huge run, spiller, thriller. That was one. Then the peg came, and we predicted again that this peg would fail. With that prediction, you saw Alpari, the broker, fail. FXCM, completely blown out, had to be recapitalized. You saw Saxo lose and restate millions. You saw IG Index lose 80 million pounds on that event because people were going long at the 120 on a guaranteed trade. They had a Swiss national banker at their back. Well, People that trust central bankers, oh boy, have I got a book for you to read, and it's got one word: bullshit, 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 written on every page. Anyway, so we've called this as a macro. This should have been an exhaustive low, something like that. This was a temporary wall in the ocean that eventually got swamped, as you do, and you end up with a draw more akin to what we've done here. Now, we told you at 108. We told you at 108, you will run parity. You are going to 71 on the euro Swiss franc. We told you there were the two previous bear calls on the euro Swiss franc. Macro moves at 108 to go to 71 with the possibility of overperformance on that, just to make the target going from 108 to 71 is an unbelievable move. You're going to fall about 37 from 108 down to there in pips. That's an insanely large percentage move. You're talking closer to around 35% loss of value, plus the overperformance. This was the overperformance that you got here in the eventual end on the peg fail. But look at that. You almost stopped at 1, even at this point over here, and you would have got out on that point over there on your overperformance rule. This is what we've been warning. We gave this to you. And then we've had people go, oh, what's happening to your trade? What's happening to your trade? The trade is doing great. You had to get in early over there like we did in our community, and you continued to stay short, and we warned you would have a rally after the parity run, just like you got on the euro USD subsequently when that did parity. So you were watching the euro run parities, a currency that was almost as big as the pound, running parities against other currencies. And we gave you the Swiss franc, and we said it will rally after you get a break. Before I pivot to the lower time frame to show you that, can you see, if I just take the eye off for a second, just look at the candles. There you ran parity, hammer, mild little move up, shooting star, absolutely plain as mustard. You couldn't run that at a second go, and then you looked one way and went the other. That is absolutely brutal rejection. This is one of the most brutal rejections, and look at the continuation you are getting on this euro Swiss franc chart. The eurozone, the political experiment that must be clubbed. They are giving you free money, and their interest rates are low. The carry cost of a euro USD short. How many times did we say euro USD short? We showed you the head and shoulders. We said this is going to overperform. We've said countless times you're going to run 0.85 and then potential overperformance to that, while the Swiss franc is running 7.1, probably ending up in the sixes, could even have a spike below further. Who knows? When things get super disorderly with bent things and everybody panics, the market overshoots. I can't tell you how big that overshoot is going to be, but I'm talking about the biggest reset where they are going to destroy financial systems. They designed the euro with failure in mind. It will be the perfect political financial structure which was guaranteed to fail. And this is where you're at. My European friends, you should be holding cash, preferably holding dollar cashes, and you should be jumping into gold, silver like never before. And you shouldn't be caring what the spot price might do, because on gold and silver, my friends, as long as sure as I am macro bull, if they do this absolute demand killing event and no one is paid salary, no one has money in the bank accounts anymore, and you suddenly are absent a payment system and you're back to barter, and everybody's finding that there's not so many farmers anymore and supply chain constraints, and you're dealing with Maslow's hierarchy of needs right at the base level of shelter, food, and heat, in an environment where you have a northern European winter coming your way. My friends, you will not be worrying about wealth and savings. You'll be trying to survive for the day. And the paper price of gold may well drop, and it will be a purchasing opportunity. But very few people will have the means to purchase at those times, except you know who rhymes with who. They will have all the juice ready in the pot, ready to go. And their entities of BlackRock, Blackstone, Vanguard will be buying all your properties off you and turning you into tenants in your own home. That is what is likely to come. Euro Swiss franc, you are now beginning an acceleration. This is a very bad piece of technical price behavior right here, right now. You have kissed that parity level, goodbye. I will drop down and show you this on the lower time frame. But we did warn you, you would likely get some degree of rally when the parity run did occur. Let's show you that parity run now with more details. I shared this chart. I even pushed it through Twitter well after all our premium guys have seen this. So premium guys were in much earlier than you on this, getting in at the 108s. This is your parity run. Look at this channel upside. I've taken all the text and the labeling off here, but you ended up having perfect double bottom with a neckline there. You broke down, you based out there, you came up. This is now a double top on two separate points of double top. You bounced on the previous neckline and you smashed this. That gives you a down leg to the parity level again. That target just run a rally again, but on a smaller time frame. Much quicker and shorter rally after you've done this more lengthy. And we had a lot of guys that, oh, you said the euro Swiss franc would go down. Oh, you said it would go down. And they were sitting up top here and crying when it was at 104. When they should have been short at 108, they should still have been in plenty profit. And now you find it down at 97. And it's looking absolutely weak. You can see the little rally after the double top made its target and it ran parity a second time. But no news headlines on the second time. Look at that little rising wedge. Squeezy, squeezy. That Japanesey. Sell me hard. Take me down. Take me down. Take me downtown. Indeed. Let's go shopping. Thank you very much for the money the Euro Swiss franc has given to our community members, to our traders. Yes, indeed. And maybe to you as a free follow. And so it will continue to the downside, my friends, even when the dollar is resting. This is a perfect counterbalancing portfolio trade, because when the dollar rests and the euro rallies against the dollar and the yen rallies against the dollar, you will be skidding against the Swiss franc. So it balances up your book very, very nicely so that you don't have 10 kicks in the backside with all your dollar dominant trades that you've got on. Remember, correlation does mess with your money management. You've got to not oversize. So let's have a look at the euro USD. Let's remind you of the macro. Yes, you saw it here first on the weekly. Head and shoulders. We called this head and shoulders, said short up top here, 117. You should still be short. Yeah, back over there. Look at that. So that short, down, 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 ran that. After the target, a bit of a rally. Let's drop that time frame a little bit so that we can see more of that down leg price action. In fact, we'll just go straight to the daily. There you go. Spill. What did you do? You ran the target. You rallied. Where's the parity mark? Put the parity back on this chart, Francis. How can you not have the parity mark on the chart? Terrible, terrible, terrible. Put him on, put him on, put him on. So where do we go? 106. Here we go, here we go, here we go. Come on, you red men. There we go, parity. There's your big blue. Change the number so that we get exactly, because it's OCDC. It's OCDC if you don't. Oh dear. Long live the dyslexia. So there we go. So you went. We in the community, we highlighted this inverted. We mentioned it a while ago. I actually missed getting in this one because I was expecting a slightly higher bounce here. But off she go. This target of an inverted HVF gave you a 9980 target. That said, you're going to run parity. What's going to happen after that? You're going to rally. What did it do? It ran the target literally there, and then you got a clear run through there. What did you then do? You rallied all the way back up to 1027. 1027, went back up to 27. Then you sat on this interim target level for a base support for a while. Squeezy. You could have done a rising wedge in there. You could see the basing ascending grind line all day long if you had missed this, and you could have got short back there. Put that line on, put him in red. He's a bagel. There she blows, there she blows, there she blows. Short him. Back in. Now you're going to get a little bit of a rally. You're going to get a little bit of churn. Let me tell you, the news coming out of Euroland is terrible. That's going to push a lot of people into the Euro shorts. You could actually have another period where you rally again. So it's not beyond the pole that you got to be careful when you time. If you didn't get into these trades when we were originally notifying you, or when our premium group, even ahead of you, were getting into them, you've got to work your way in carefully, and you still got to have stops, and you've got to try catch it before it does a major move to the upside or has a renewed run to the downside. So you need to break and enter into trades. And you need a little bit of good fortune and some technical nous to do that. So we may get a little bit of a broadening structure there for a bit before it goes. It could churn for a while, it could spill, but you need to engineer a situation. The best situation would have been getting in maybe on this rising wedge structure like that when it was there. and you could have broken into the trade at that point. But now, of course, that's easy to say in retrospect. You're not in, and now you need to wait in. It's a bit hardcore to jump in here. Your nearest stop would be up top there. Dangerous. So you have to wait till you get given a gift and a new structure. Okay, so there you go. You could have got in early on that break, by the way, inside the squeezy. Note how you went up to the axis. So actually, you could have been a short a little bit early. We were expecting that, but with travel, I missed the rally entry. I had a limit sell here. So I'm not claiming any of this, apart from the fact that I'm macro short the euro and have been across the Swiss franc and the euro USD. But I would have liked to have added for a tactical trade down to here and just taken some out, margin stack the account for the next down moves. So this is what you've been getting. Euro. You should have shorts on euro. But careful how you enter. That's the key point. Money management applies. And if you're already dollar dominant long, rather add it on the Swiss so that you don't get kicked when the dollar rests. Let's have a look at that Dixie. A little bit down today. That'll probably be as a result of the yen, the euro. We're having a tiny rally. This still points to the fact that this could be in a bit of a broadening, and you could still be soft from a dollar point of view. You could still be soft from a dollar point of view. That's why Bitcoin has been so disappointing. So disappointing. It hasn't done well. It hasn't done well at all, given that actually the dollar's kind of resting since it was up top here. It's been resting and pulling back. Bitcoin should be killing it. If it's truly a bottom, it should be killing it. It should be going up in an environment of bad news. But what's it doing? It's down here, 21,250. It's bounced on our 29.50 key level of significance. This is what you're getting. And I still say to you, it's a broadening structure. Sure, you can get a little rally inside the structure. It's not necessarily right now ready to go. But when the NASDAQ starts to fall, you've got to have a look at this. Let's pull up the indices. We'll pull up the indices and the equities for you as well, because there's really interesting things to be seen there. How many times we started comparing Bitcoin to the tech indices long before anyone else. Everyone in crypto was just, it's all about Bitcoin. It's all about on-chain analysis. It's all about this, and forgetting that Bitcoin is being measured against something else. And that was your big macro. So if we get up the tech indices, let's have a look. We will go the IXIC, that's the NASDAQ composite. If you go the weekly and the monthly, our view is that this is going to continue a correction far lower than people imagine. You are still in a head and shoulder and you have a target to get. Everybody bottom calling. There's been too much bearish sentiment. It must mean it's a buy, therefore. It's not always that simple, that it's just, there's too much bearish sentiment. These guys are going to hold the pain for longer. They need the dollar dominance to come back. They need the bid on the dollar, especially at a time when there might be new challenges coming. And they want to push the recession that starves the rest of the world of dollars, because the Americans are not importing goods. They're not sending dollars offshore, and they're not buying goods from Germany, Japan, and South Korea. So the Western-friendly nations are getting destroyed by the dollar. The yen, the Korean won in time, it's already moved up a fair bit, although it's chilled at the moment, and of course the euro. So it's not helpful to be a friend of the dollar in these periods where it's trying to maintain its dominance. So let's just do this. Let's put this on a monthly chart and just highlight something. I'm going to logarithmically do that, and I'm going to take my jaws off for a second so that's not so messy. I'm going to split this chart for you. This is an example of what Bitcoin is looking like. That's the Dixie at the moment. Let me just put Bitcoin on there. Add him in, BTC, USD, BTC, USD. We will take Bitstamp, why not? So 2 weekly, and this is the 2 weekly as well. So let's just highlight this, and let's also log scale you, my friend. There's 2020 under 2020. We're pretty much aligned there. Let's pull that tiny bit through. So Bitcoin came into existence throughout this entire inflation of the tech boom. Basically here. That's where it came into existence. That is your top at 2022. It slipped slightly out of kilter there. Let me just Put it like that. And that is your secondary 69K top. People who don't see this combination of tech-based assets. There's your tech top. There's your 69K Bitcoin top. Now, as long as you think this is going to chance of making my head and shoulders, and I can put that drawback on, but you would need to, let's just do it quickly and let's see. For the upper half, let's put the drawback on. That's already going to be at minimum to target 9.2. It's a further down move at minimum to target 9.2, friends. And by the way, I think that's a secular reversal. We're going to go peak pain 9.2 at minimum. Yeah, and you're at 11.5. What do you think about this? Now, if you're looking at that, everyone wants to bottom call on those three little tiny candles over here. That's your bottom. At these bigger time frames, that still qualifies as a flag, although on the smaller time frame, I say you stick your nose out a little bit out the top. But that is not a bottom. That is not a bottom at all. And this is in a head and shoulders to the downside. You have not existed. Still battling to keep these properly lined up. It's close enough, but it slips a little bit away. So there you go. That was when you came into existence. Let me show you what happened prior to that. So if I move 2012 to where 2014 is, and I move 2012 to where 2014 is, in fact, I'll go a little more. Move the 2012 to 2012. You will see when Bitcoin started. There's your dot-com boom. There's your crash. There's your bounce. There's another crash. None of this did Bitcoin see. None of this did Bitcoin see. That's monthly. Let me change this to monthly too then. None of these down legs has Bitcoin ever experienced in the tech sell-offs. The dot-com crash wasn't around, and the 2008 GFC crash wasn't around. To there. Bitcoin came into existence during this secular minor low here, which saw it do that. During that download over there, that down sell-off. Let's draw that one more time, and let's perfectly align them. This is on your monthlies. So if you want to call this a bottom on a monthly, that little green candle, I would like to suggest you think again. And it's less of a green candle than the tech green candle is a green candle. So your favorite token that you say, I've been following the trend. I get these guys saying, I am following the trend. The trend is macro up. The trend is macro up in an environment where every risk on asset was macro up. Talk to me about how you think your Bitcoin might have done if it was in existence during these periods. You don't know. And I can tell you, it sold off high beta here running into 2012 on a much smaller sell-off there. That was just a pullback in a major bull market. So that is your asset category. If we go back to crypto and just look at the Bitcoin chart, let's take it out of that into singles. It's going to leave me with a NASDAQ. So we'll put the BTC in there. We'll stay with Bitstamp because it has long history. So taking this monthly, that is not safe. That little green candle is not safe, friends. Even on a regular chart, it's not safe. Doesn't matter how you look at it. It is not safe at all. Have a look at it on a 2-week. That is not safe. It is not a bottom. It is not a bottom for you to be calling. That is not enough to justify a bottom. As I mentioned, you could still, on the bigger time frames, set this up as either a rising wedge or a flag. You could have something like that, or I could have a different color. Maybe there's a squeeze in there like that, with a splitter in your wedge in the blue, or your splitter in the pink on extending flag. So a lot of people show up and say, you were bearish Bitcoin. It's gone up. It touched 24 and died, my friend. It touched 24 and died. So Bitcoin is in trouble. Bitcoin is in trouble, and this is not a strong rally. Also, Bitcoin versus tech, if we have a look at that. How's it performing? Bitcoin divided by IXIC. Again, you could make a rising wedge or a flag out of that still to come. I would expect further downside in the event of the NASDAQ going down. The NASDAQ has a head and shoulders that still have it to go down further. And I can tell you that the S&Ps and the Dows made targets and probably have further downside to go if we have the peak pain scenario that is our primary bias. That is that the Fed is going to keep tightening. So let's analyze. Why do you think they redefined a recession or challenged the existing definition and start telling you that all economists see it differently all of a sudden? Well, probably because today we're going to find out they are in a recession and they're quickly running to preempt and firefight, number one. Number two, it's their intention to keep pushing the interest rates in the name of chasing inflation, which is part of it, and exporting that inflation to Europe and reducing it in America and Japan and all the other currencies that will now fall against the dollar if they push dollar dominance by continuing to do this. Let's just have a look at this head and shoulder that we drew for you here. So just to prove to you that you are just in a rally post a target run on a head and shoulder and probably in a rising wedge on the weekly here. There's your left, your head, and your right. You can see it more clearly on the lower time frames, on the daily. Complex head and shoulders. By the way, go book a call. We explain all of this to you, how and why we do it. So don't get caught chasing rallies in what could be peak tightening, peak fear, kill demand on an even bigger basis than they did in previous events. They have to keep pumping ever bigger and dumping ever bigger to justify an ever greater pump. You are actually talking, I mentioned it on the interview with Patrick and the guys of North Star Bad Charts. The original crypto pump and dumpers are the central banking cartel. They make their money by introducing ever greater volatility, hence a megaphone on the Fed's fudge rate, the Fed's fund rate. I've shown that one before, and I may be able to find it and send it out. Follow us on Twitter at themarketsniper.com so that you too can see some of the charts that I don't have immediately to hand. So you have both the Dow and you have the SPY that ran their head and shoulder targets, and you have the NASDAQ with them still to come. And they are in rallies. They will push lower as well, in our opinion. This is a dangerous, dangerous time. And then there's elongated muskiness with his Tesla shenanigans and all his shithousery on Twitter and everything he's done. Who dumped Bitcoin? Who was a diamond hands? Diamond hands, crypto kids, all embraced elongated muskiness like they could trust him. And we said, no, 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 do not trust him. You've supported on this funnel. That's natural that you have a rally to go on up. But in the longer view, we expect to see a sell-off to the downside. Plug that battery car in. Burn the coal furnaces to charge those battery cars. Sounds good to me. Yep, they should force everyone who charges battery-driven cars to recharge their cars on solar, on wind, and all the renewables. Otherwise, you're no better than a good old grease-burning diesel car. That's my take anyway. And ARK, also, some element of recovery, but not near as much as Tesla. All that high beta tech, I would redraw this rising wedge and say you're still having a potential event where you will squeeze upwards and then you will be let down. Let down to the downside. That's how I'd reframe our ARK for the downside. This is one that, if it sells off, could go. And this is round tripped. Imagine your tech market is to do something that resembles ARK. On the NASDAQ, you're around about here. This is a complete blow off up and blow off back down to these current levels, which is why you're pausing for a while. It was at that broadening structure over here that you then had the amazing 6 or 7 trillion. Where is our friend Hunter with his 60% pump in 4 to 5 months blow off that missed this entire pump, which took ARK, by the way, from $32 to $160. Fancy that for a bit of a blow-off growth, thanks to 4.5 trillion, 6 trillion, 7 trillion. Who knows? We dropped a couple of trillion down the back of the couch. Who knows how much? How much went to the slush funds of the military-industrial complex, etc., etc. Anyway, but that's your blow-off, mate. He's waiting for a blow-off. I don't understand what he's looking at, that he's waiting for a blow-off. Even Amazon and these bigger guys still had the blow-off. Still had a blow-off. But Amazon has come a long way back down. Will Apple, which also had a March 2020 blow-off, that was 2019 lows, that was 220 lows. Apple, a major stalwart, the biggest, $53 to $182. I'm looking for a blow-off. I can't see one. One of these days we'll get it. Come on. This thing could come a long way down. If it was to do an arc, it could come back to the lows of 2020 or more. It could be a heck of a sell-off. By the way, also in a head and shoulders. Let's show you, because we kind like that, aren't we? This is what you'll be getting, regular updates in terms of what we're doing. I would say that's now your extended potential shoulder over there. And you have had your final top high. You failed to make a new high. I would imagine your neckline's roundabout right there at 138.50. You've pushed through it. Now you've got a right shoulder. It's yet to take out the high of the left shoulder. And a sell-off from here and a trigger through that. How low might you go? Well, the head and shoulder says you could do at least 94. And as I showed you on the bigger time frames, if you round trip back to the lows of COVID, because we get a demand-killing event of least the same scale as lockdowns and killing the SMEs, and if you had bigger, God knows how low we could go. This could fall a long, long way. Okay, so we've covered equities. We've covered the Euro Swiss franc. We've covered the Euro USD. We are also seeing, for now, pushback on the USD JPY. We've shown you the Dixie. We actually think the Dixie can still come back a little bit more. So that might mean the yen remains fairly firm, given how much ground it lost. It's had a huge run. So any form of a pullback. Remember, it made its 136 target. We gave you the 138, and it was a much smaller structure. It's kind of like, I come in and you've got an amazing house and I offer $5 million for it. And then you go, no, offer again. I ain't selling for 5 million. And I come back and I offer you 5,005,000. What am I signaling to you? I'm signaling to you that I don't have too much more in the tin. My first offer was as close as damn it to my best offer. That's what happened with the USD JPY. The smaller structured HVF was telling you you're only going to get a tiny bit more out of this barrel, bud. When you made the 136 up top here, you're only going to get a tiny bit more out of the barrel. Let's drop it to that 30-minute time frame so you can see that structure. You only got a little bit more left in the tin. We might need an hour. Go to. There was the upside HVF, 138.25. So that was the squeezy. It's not drawn on this particular one. And we gave this to you on live trading day. Get out. Get out over here. Get out over here. Since then, pull back, pull back. This also looking a little bit flag-like. I could still see a little bit more downside on the USD yen. This is all because you're at the key level of significance, the macro target of a monthly chart. That saw you run from 107 to 136. So you might rest here. So I still don't think the dollar is going to be particularly exceptionally strong. And that's one of the reasons why Bitcoin isn't yet ready to fall. So it's going to stay and churn around a little bit. But if we start to get real fear and breakdown, we could start to see that dollar start firming again. So what about that trade? So when I was on with Patrick on Northman's Polestar charts, I shared something we'd also shared inside our premium community a number of days earlier, saying, beware the Hong Kong dollar, the USD Hong Kong dollar. So I've told you this. We've traded central bank pegs before. Everyone thought we were stupid. It was an exercise in futility on the Euro Swiss franc until it broke and suddenly spilled. It was beautiful. It was amazing. And all pegs will fail is my default position. But you can't hold for 5-10 years waiting for it. You need a sense of timing. Could there be And you've got to understand there will be many false dawns with these kind of timing trade. We had it on the Korean won in 2019. It triggered and then it pulled back in. We printed 6 trillion. Hey, so of course the dollar's not going to go in a runaway break against the Korean won at that point. But now that time is changing. So let's have a look at that trade. 1:1400 could be attained. Now, what's the odds of that? You should say pretty low, but still, is it better than 1:1400? In my opinion, yes. You might have to take the trade 10 times. You might lose 1 unit of loss, which could be $100, $250, $1,000, depending on your account side, 5 or 6 times before you get your winner. But once it breaks and properly runs away from your entry, you're unlikely to look back. And you still may have to hold it for an extended period. And in fact, your brokers in chief, one might try to up your margin and shake you out at some point. So make sure you're suitably resourced. Make sure, counterparties risk is going to be the new big risk with brokers and all of the enablers of trading in this environment. I have no doubt at all. So you could even be right and brokers could go down because the moves are too large. The liquidity providers are no longer providing for them. So there's a lot of risk. But here is the trade. Let's just clean the face. So first of all, I'm going to show you the monthly. So round about Faulkner's tightening era. You notice the similarity? Faulkner's interest rate tightening era that caused strength to the dollar to kill runaway inflation. Note. That was brought about through the 70s, 1971, Nixon. Too much money spent carpet bombing the jungle of Vietnam. An incredibly expensive activity, an incredibly destructive, poisonous activity, especially when you use Agent Orange, who's about as toxic as Christine Lagarde. And as a result, people started saying, we think you're spending a little much. We'd rather have the gold than the fiat that you claim is backed by gold. So give us the gold instead. Whoops, a run on the dollar's gold. And next thing, what did you have? But that led to a sustained period of a real big inflation that Faulkner cured and refirmed up the dollar and starved. What happened? During that period, the Hong Kong dollar went from 4.67, and I take the bottom of this range right up to about 7.7. So 4.7 to about 7.7. You're seeing about a 75% deval over there. Well, an increase from 4. It's almost a doubling, but not quite, about 75%. Were you to have a similar percentage climb from roughly the middle of the range that you've traded in, that is essentially a peg, a bottom and a top of Hong Kong. And can I point out, Hong Kong H1, worst year for IPO listings. This is a banking cartel. It's a city of London inside what is soon becoming China. Now, if you're about to list your company, would you be doing it in Hong Kong with the current problems, Chinese government, or would you choosing somewhere else, maybe London, New York, I don't know, even Euroland before Hong Kong? So they are losing revenue as a result of the gray area they find themselves in with regards to China, and as a supposedly Western-friendly banker, IPO, capitalist listing, sitting inside what is essentially a communistic environment. It's a very precarious situation. So their revenue is going down. They are burning their reserves. As big as those reserves are, they are burning them to maintain this peg. So the percentage gain from around here would, if it was a similar degree of move, would take you to about 13.1 from about 7.8. So bear in mind that's almost 8, and it would take you through roughly 13. I've not gone the most aggressive. I only went to the bottom of the range here. You did in fact overshoot here as part of that, and I'm projecting from roughly the middle of the range up. So this is geometric, percentage based. It's a guide for having a target. That would take you to 13. Okay, interesting. But when's it going to happen? We don't know. You could sit. This has been held, by the way. This peg has been in existence since September 83. So you had a blow off through the top, and then from there it was in the range. Call it November 83 to today. But let me tell you, these are the times when things fail. 83 to 22. That literally is a 40-year peg. So why should you trade a break of the peg now? Well, the day is coming, in my view. The day is coming when this may fail. And as a result, there will also be limited opportunity to put these trades on. In fact, if you look through the entire peg period, there's only been one other place where you traded this high. You were allowed to trade this high in the range. So let's go through this whole peg period. Look at this. This high in the range, around 7.85. You touch, sold off, touch, sold off. This was during the Shanghai Accord of 2016. You went up from those lows all the way up. 18, 19, then 20 came. They printed so many dollars, you went right the way down. And that was the killing of the dollar. Now you're back up. So let's have a look. How many times have you been up here? See that red dotted line? Throughout that 40-year period. Let's go to the 80s. I remember the 80s. 91 was a great year for music, by the way. What a year. There you go. You are not, look at that red line there. That is top end of the range. Apart from these spikes as you first settled into the peg, none of these highs were ever that high. There, much lower. There, much lower. Only more recently, in 18, for a sustained period there, a sustained period there, and a period there. And only getting relief when America printed. Not just for America, but for the rest of the world into the COVID lows. So now you find yourself back at similar highs. And what do you see? Well, you may see something, you may not. It may be noteworthy, or it will spoil. But for example, if you were to enter, and we entered here along there, I've already held positions before this. I'd come from the last upside HVF here, over there, and have been holding the Hong Kong dollar for a sustained period now. But I am wondering now, is this an ascending HVF, which could be the final straw that sees eventually, they say, how much good money do we throw after bad, defending a peg that can't be? And as a result, three nice little impulses squeezing along the bottom, the bagel there, and that flat top, that oh so flat top that tells you central banker intervention. And you are trading up. So for those of us that got along here, and we're putting the stop down there, under the second low, not under this third low. It's a bit higher risk, obviously, under this third low, because you could dip down a little lower, just wick below it, and then come up again. Because there's a certain amount of skittishness, but it's pretty decent and clear. Watch me now, draw with the fat cokey in a simplified format. You see you do get a little bit of complexity there, little dip, and then you did come down a second time, but you didn't make a new low, so that was your first low. You did go pretty cleanly up and over. You see you made a low, but then you made a marginally lower one, a bit of chop and churn. Final low is there. And then you went up and over. So you can't say for sure your third low is in, but you tweeze the bottom twice and you've gone up. So now you're entering much later. You might be entering much later than us, but you could still manufacture an excellent risk reward. How much is this one as it stands for those of us that had already entered? That's our community. Well, I will tell you, and we'll have to go back to the monthly so that you can see the top end of that. The run to the 13 level, as it currently stands, as a risk reward trade, wait for it, is the unbelievable number of, note, rescaling till 13 shows up. Where's our risk reward? It's not showing us. Now you're really letting me down. Have to make it a bit bigger, maybe. That's an anticlimax. Where's my 1400 number? Back down to the 30 minutes. Let's see if it'll show us there. Oh, before I do that, let's just make this thing a little bit less fat, shall we? Because it's just so difficult for scaling. There you go. Risk reward was hiding. I just had to thin it out. 1,446. For every $1 you risk, 1,446. For every $1,000 you risk, 1.4 million. Yes, that sounds great. So let's see how you, getting in late, would potentially look at this trade. So 12 hours. Give me the action. So if you were to be getting in now, you would not be able to buy at this level because you're not in the premium community. Sorry, just book a call. Become part of it all. But let's say you put a limit order bid there. to get filled. Never chase a market too aggressively. Put a limit order to be filled there. And you gave yourself a little bit of fat. And instead of going right under that one, what if it just had another teensy weeny little dip? So you give yourself a little bit of joy down to there. You would get yourself a 1,580. 1,580 risk reward. You will be buying higher up. You'll make less points than us. We, of course, once it breaks, will bring our stop up from here, if it were to break to the low of here. So you have now seen me demonstrate how you can restrict your loss to $100 and where you would place that stop. I would put a little bit of fat on that over there. Don't forget spread, by the way, as well. So there is spread in it. Don't be too penny wise and not allow a little bit of spread. Or if you wanted to be super safe and you wanted to have your stop at the same place as us, you could settle for a very paltry and disappointing 985 risk reward ratio. You can see this is flicking. You might be lucky and you might be able to get in a tiny bit lower. Then you can get your 1,000. There's 1,004. Put your limit order in. But remember, this can all fail and we can sell off one more time if the dollar is soft. But I'm not seeing it soften much against the Hong Kong dollar because the dynamics in Hong Kong are bad. And you've got the Japanese that have devalued immensely. You've got the Koreans that are in the beginning of a devaluation process. We've been long since 1100s. It's at 1300s at the moment on the USD Korean won. It's going to have to devalue to maintain. Kias are going to need to maintain competitiveness to Toyotas and Nissans. Samsung's going to have to maintain competitiveness to Sony's, etc., etc., etc. And as a result, the Japanese having a huge export advantage on a major devaluation of their currency is going to see knock-on effects on the competing nations. You would have just got very close to a fill on that downside tick there for a 1,000. So there you go. You have my 1,400 plus, which actually I would reduce the risk even further once, and if we were fortunate enough to get a break to a stop closer up there, which would increase that risk reward. But we always count the initial risk reward at the point of departure, because that is your highest point of nerves. Once this moves, if it were to move beyond the limit, you would be in a very powerful position. And once it's moved aggressively away from your entry, you're in the pound seat. Okay, guys, thanks for watching. It's been a lengthy video. You have now witnessed a 1,400 plus risk reward trade that is part of our premium community. If you like the idea of risk managed trades, that could be wealth rainmakers. By the way, this could fail 9 times and it wins on the 10th. You may get many instances where you get little squeezing points. They rein the dollar back. They don't want it to happen just yet. Boom, 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 bosh. It sells off. It comes right down to the bottom end of the range. I will take it many times. I will be wrong 9 times. Show up and tell me I'm wrong. You're not impressing me. On a 1,400 RRR, I expect to be wrong. I expect to be wrong not once. I expect to be wrong 9 times. I only have to be right once. All those other 9 are paid for. Please understand, it's not about being right or wrong. This is an aggressive, most likely to lose, highly speculative trade opportunity that if you happen to get accurate, when and if, after many attempts, you will have all your previous attempts paid for and Christmas every day for the rest of the year. Okay, thanks for watching. Don't forget, go to themarketsniper.com to book a call. Check us out for similar, always seeking real, highly expensive reward to risk trades when and as the timing for such events are becoming more and more likely, yet always accepting and pricing our trades for loss, despite anticipating the potential of the great reward. Okay, thanks, and we'll see you on the other side. For my crypto friends, be careful out there as well on the risk on. I think they're going to push it. That whole redefinition is about pushing the pain beyond the normal points. We have more of a crash to come, in my view. Bye for now.